We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always go to the website to learn more about Brian and the team. It is deckerretirementplanning.com, deckerretirementplanning.com. And I always say this at the start because it's an opportunity for you. If you would like to learn more about different areas of retirement, you can go to that website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There are about a dozen things you can download, including Brian's book on retirement, The Decker Approach. There's a 3 Principles of Retirement book. There's a checklist challenge. There's a sample income plan. That's just 4 of the 12 things you can download right there. Decker Retirement Planning under the heading of Safer Retirement Education. It's all there just for your information. Then if you have questions, you can always give the team a call at 833-707-3030. All right, Brian, you and Mark, you got a dazzling, just a fast-paced, such an exciting show today. I don't know if retirement planning is ever exciting, but it's certainly important. And today, you guys are going to be discussing inflation.
It's the number one killer of purchasing power for people in retirement. So, gosh, think of this 40, 50 years ago. I remember filling up my motorcycle for 25 cents a gallon gas. I remember that. I remember in the 60s when homes cost $12,000, $15,000. I remember when I thought people had made it because their pension gave them a monstrous amount of $30,000 a year. Well, if you live long, you've got to have inflation protection because your purchasing power is going to be eaten away unless you have protection from inflation. So, Mark, let's talk about the 5 ways that we at Decker we protect people in retirement from inflation.
Yeah. Brian, you had mentioned going all the way back to the 1950s. I earlier last week, I actually did a lookup on inflation. And I said, okay, over the last 100 years, if I had bought something for $1 back in 1925, what would that thing cost today in 2025? So 100 years later, that $1 item would cost $18.51 today. That is a 1,750% increase in price. So that just tells you the value of your dollar is slowly being decayed by inflation. So when we're looking at clients in retirement and making up a plan for them for the rest of their life, including inflation as a component, we want to make sure that we are providing systems in our planning process that can address the concern around the loss of purchasing power in their portfolio. So you had mentioned there are 5 layers of protection that we look at here at Decker that we can use to minimize the risk of inflation as a silent killer in their plan. The first one is to build it into a plan. Put it down on paper. It's why every single client that we work with, we make sure that we build out an income plan that includes rising cost and rising income in their plan, because we know that the price of food and energy and entertainment and everything just continues to go up and go up. Here in the Pacific Northwest, I mean, we run into property taxes that go up 1%, 2%, 3%, 4% a year. And these are big numbers. And those taxes are increasing significantly every year. And that can really eat away at a portfolio. So we want to address that as part of the planning process. But then we look at other kind of infusions of cash into the income plan. So this can be things like inheritance. It's not always fun to think about, but an inheritance is an infusion of cash into your retirement plan. And that infusion of cash can allow you to spend more and increase your income in retirement from your portfolio. But also things like hard assets. Here you're looking at real estate, you're looking at precious metals, anything that has a physical component to it, but also an investment component to it. So take your house, for example, or real estate property. And we saw this here recently during COVID and 2022 when we saw inflation, the value of hard assets increased significantly as a response to rising inflation and rising interest rates. So hard assets have a way of keeping up with inflation over the long term. We also see oftentimes retirees will get to a point where they no longer want to take care of the large house, take care of the 3-acre property, and they'll often sell and downsize to a smaller rambler on a smaller plot of land or even a condo. So when that downsize happen, usually there's kind of an infusion of cash into the portfolio. And I heard a really fun snippet that says in retirement, you can't eat the living room, right? You can't access the equity in your house if you're living in it. So a lot of times people will sell and the proceeds from the home sale will become the sources of funds that they use to kind of have the quality of life that they want in retirement. So the last one, and this is probably the most important for us on the financial planning side and the wealth management side, is you need to have a growth engine in your portfolio. You need to have something that is generating significant growth in your overall portfolio. Here at Decker, we use what's called our risk bucket. And our risk bucket is your stock market component of your portfolio. And over the last 30 years, the S&P 500 has generated about 9 to 12% rate of return on average. And when you get those types of return in your portfolio, you're able to keep up with and even beat inflation over time. So you stay ahead of taxes and inflation because of the growth component in your portfolio.
So, Mark, I'm going to sum those up. We mentioned that there's 5 different ways that clients can protect themselves from inflation. The first one you mentioned is a cost of living adjustment, COLA, cost of living adjustment that is priced into the plan so that clients are getting more and more money each year. Now, that's a two-edged sword. Just take a second, Mark, because if we put the COLA too high, then during their healthy travel years of 65 to 80, for that 15-year period, they're getting a lot fewer dollars than in their late 80s and throughout their 90s. They're getting a lot more money when they're probably not traveling as much or spending as much money in your 90s and late 80s. So what we do is we flatten the COLA to push more money up to our clients during their healthy travel years. We want to have you in your healthy travel years have the funds, but we still want to have a COLA, cost of living adjustment, so that every year you get more money. That's number 1 of the 5. Number 2 is having hard assets like real estate. If you own your home or homes, plural, in rental real estate, things like that, hard assets go up when there's inflation. Hard assets like real estate, hard assets like gold and silver and other commodities, they go up in value as inflation continues to be a problem. It acts as a hedge with the real estate that you've got, residential or rental. The third thing you mentioned is if there's any inheritance. If there's any inheritance, we add it to the portfolio. We want to make sure that we are conservative, but also accurate in showing those funds coming in. And the fourth thing is the downsize. The downsize in your late 70s, early 80s, your back hurts, your knees hurt, everything hurts. Gardening's no fun anymore. The stairs are a chore and a problem. And so that's when your friends call you on the phone and tell you to move down with them so that they can all enjoy each other's company, but you've got doctors there and things like that. That is your downsides. When you sell the home for X and buy a condo for Y, there's usually an infusion of capital into your plan of $200,000 or $300,000. And then the last one you mentioned is the risk bucket. When you have a risk bucket that's growing, the stock market returns, you've got a good inflation hedge, because if the cost of money is being reduced by 2 or 3% a year, which is the Fed's target, that's what they want, then we've got to make sure that your purchasing power is retained by growing some portion of your portfolio. So, Mark, want to make sure that when we come back from the break, we talk about how to responsibly grow those funds in the risk bucket.
All right, so glad you're with us today for Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Talking inflation. There's a lot going on when it comes to inflation, and sometimes we get caught by surprise. Brian and Mark will talk more about it when we come back. But again, if you'd like to sit down with them, try to figure out where you are. How does really inflation affect us in our situation? Are we good to go? Can we retire? Well, when? Do we have enough? Or will our money last as long as we need it to? Are we going to be okay if we retire? Those are big questions, and you don't want to do it by guessing, hoping, boy, I think we're going to be okay. Why not sit down with a team like Brian's at Decker Retirement and sit down and talk with the advisors, figure out where you are, what you want out of retirement, and where you are on that path. 833-707-3030 is the number. No cost to you, no obligation. 833-707-3030. Might be the most important phone call you make. 833-707-3030. Brian and Mark back with more of Safer Retirement Radio right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement, because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Brian and Mark are talking today about inflation. How does that affect you? And they went through some numbers to start with, but inflation is crazy. If you're retired, Brian, for 20 years, and you say, let's say you retired this week, and you needed $5,000 a month. You said, I'm good with $5,000 a month. In 20 years, my guess is it's not $5,000 a month anymore, is it?
No. And you're seeing that with the value and prices of cars, homes, food. I can't believe that what a gallon of milk costs now. So it's you see the value of the dollar going down because the purchasing power, the ability of $1, what it can buy, is going down as years go forward. So we need that protection. Now, we ended the last segment talking about the 5 ways that we protect capital. The 5th one, the last one, was having a risk exposure. Mark, if you go out in the banker broker world, it's a 70-30 portfolio. What's ours at Decker?
So at Decker, when we structure a portfolio, this is the growth engine of the plan. So we want maximum growth. So we're actually utilizing a 100% stock portfolio as our risk bucket because it's the longest bucket. It has the longest runway to grow and see those stock market returns. So we don't need the money in, 2 years, 5 years, 10 years. We let that money grow for as long as possible so that we can see that the statistical average rate of return that we've seen in the stock market over the long term.
Okay, now let's throw a monkey wrench into this, Mark. There's been 4 times that the market valuation has been about this high. Only 4 times. It's only been 4 times where the S&P 500 trailing valuation was over 30 times earnings. One was 1929 and markets were flat for 17 years. The second was 1964, markets were flat for 18 years. The third time was November of 1999, markets were flat for 14 years. The fourth time was November of 2021. We hit 32 times trailing earnings. If history repeats, and it's been 100% accurate in the last 100 plus years, if history repeats, what that means is that you have risk that the next 10 to 15 years in the stock markets will be flat if you use passive investment strategies. Passive investment strategies are buying and holding stocks, ETFs, indexes, mutual funds. The buying and holding those things would be passive. And if history repeats, and with 100 years of history, we're talking about it's been 100% accurate. We hope for the best. We hope markets continue to go up from here, but they never have, not over a 10 to 15-year period. And we're seeing more and more people, more and more research arms of banks and brokerage firms coming out and saying that the next 10 to 15-year estimate is flat for estimated returns for the next 10 to 15 years. I just saw Abby Joseph Cohn of Goldman Sachs come out over the weekend and say that her 10 to 15-year projection is negative, actually, negative 7%. So, Mark, when we have a situation like that, how can we protect our clients for inflation if we're looking at a flat market cycle?
Brian, you make up a number of really good points there. We as financial advisors need to make sure that we're looking at not only what the stock market is doing and valuation there, but also in our last segment, we talked about inflation. They're not always aligned. Just because we see rising inflation doesn't necessarily mean that we see rising stock prices. And so we need to have a very specific, very intentional investment strategy that allows us to take advantage of up markets and down markets in our portfolios so that if the market goes up, we want to capture that up. And if the market goes down, we want to protect clients from that downside risk as well. So we call it our two-sided investment strategy or our two-sided model. It uses momentum strategies in the stock market to identify where the momentum is in the market. So whether that's in specific indexes or specific stock sectors or even individual stocks themselves, you're able to identify using very complex metrics and matrices, identifying where the momentum is, where the smart money is moving into in the markets, and you ride that wave for as long as those investments have positive momentum. And then if the market changes direction, let's say we do enter into a market that's headed down, we want to make sure that we have strategies in place that protect our clients. So the momentum strategies and also using stop losses as part of the strategy itself have done very well over the course of 20, 30 years of protecting our clients from downside risk while also getting upside growth in their portfolio. So let me give you kind of an example of what that looks like, just so you can kind of big picture see what that would have looked like over the long term. So here you are. We'll go all the way back to the dot-com bubble in 2000. So in 2000, the stock market hit those valuations that Brian had mentioned, 32 times trailing earnings, all-time highs in the stock market. And from there, we saw a massive market crash. We saw the NASDAQ down about 70% coming off of the 2000 highs. We saw the S&P 500 down 50%. But primarily, that was in the tech sector side. That didn't apply to everything in the stock market. There were areas in the market that you could invest and still make money. And momentum strategies can identify that situation, and they can move you into things like precious metals. They can move you into healthcare. They can move you into pharmaceuticals. They can move you into real estate. All of those sectors actually made money in 2000, 2001, 2002, when the stock market was in absolute free fall for 2.5, 3 years. But then the market did finally bottom out and it started to recover. And momentum strategies identified that positive momentum coming out of the market crash. And from 2003 to 2007, this was the recovery before the housing market crash. The sectors that were performing especially well during that time frame was it was emerging markets, it was the tech sector, it was semiconductors, it was real estate, banking sector. All of them were doing very well coming out of the tech bubble crash leading up to the housing market crash. But then we saw like a waterfall event. This was 2008, 2009. The stock market was in absolute free fall. And for so many people, that was so traumatic, watching their portfolios just get whipsawed. One of the core features of our investment strategy is to have stop losses in place. So if we see that kind of a waterfall event and the market is in free fall, we care so much about our clients. We don't want to put you and your portfolio and your retirement plan at risk of what's going on in Wall Street. So having stop losses in place allows us to exit out of the portfolio. Yeah, we might take a little bit of a hit, but we won't take the big hits. And then we just sit and wait for positive momentum. And during 2008, 2009, the only sectors that had positive momentum were bond funds. So we were able to move into US Treasuries and bond funds as a way of protecting you from stock market exposure, but still make some good money. Bonds were up about 22% during that time frame. When the rest of the stock market was down, you're in very safe, very conservative positions. And then from 2009 all the way basically to today, the market has been in an uptrend. And I believe it's kind of lulled investors to sleep, thinking that you don't need professional money management, you don't need somebody giving you financial advice because the market always goes up. And maybe every once in a while there's a little blip on the radar, but it's quick to recover and it's nothing at the end of the day. But that's not the long-term historical story. And if we don't have a wise, intentional investment strategy in our portfolio, we can really get hurt, especially in retirement.
So, Mark, you mentioned a critical point about a two-sided model. There's always something going up. So in 2000, 01, and 02, like you said, the dot-com bust, that was a 50% drop for the S&P, 70% drop for the NASDAQ. And during that period, real estate through the REITs went up, gold, silver, energy, pharmaceuticals, biotech, healthcare, many, many stocks and sectors of stocks, bunches of stocks did well. You couldn't even know. Many people would not have known that most of their friends had lost half their money if they stayed with momentum strategies in 2000, 01, and 02. And then the markets took off from March of 03 to October of 07. And in that 4.5 years, the run was in technology, semiconductors, small caps and emerging markets. They made tons of money. Then rolling into 2008, everything went down. Was stocks and commodities except bonds. Bonds were up 22% that year. The last time we had a big drop in the market was 2022. S&P was down 19%, NASDAQ down 33%, bonds down 20%, commodities down, except for energy. Anything energy related, the natural gas companies, crude oil companies, the pipelines all made 15 to 20% that year that most people lost at least 25 or 30. So this is a way for clients to take the risk strategically down quite a bit. Now, when we come back from the next break, we're going to talk about how one more layer of making sure that we can get the exposure and the gains from the stock market, because they're so critically important to the 5 key ways that we reduce inflation risk in clients' portfolios.
Again, if you'd like to sit down and have a conversation with the team at Decker Retirement, it is 833-707-3030, 833-707-3030. The Safer Retirement process focuses on income planning, distribution planning, so it's about income. It's about investments and your risk. Are you taking too much risk? Not enough risk. It's about taxes. That's a huge thing in today's retirement world because of IRAs and 401ks, the traditional side that have not had any taxes taken out of it. When you hit the RMD age, the government wants their money. So you got to figure that out. Tax is a big deal. Healthcare, long-term care, huge deal. And then, of course, legacy and estate planning. It's all part of the process at Decker Retirement. Inflation is certainly a factor. It's going to affect your income without a doubt. 833-707-3030. No cost, no obligation, no pressure. 833-707-3030.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Again, the website, deckerretirementplanning.com. You want Brian's book on retirement, the Decker Approach book. It's under the heading of Safer Retirement Education on that website, deckerretirementplanning.com. We've been talking about inflation, and there's a lot of different areas that Brian and Mark have talked about already. I know you wanted to kind of wrap up that and then maybe move to a little bit different area of retirement planning.
Yeah, Mark, we want to cover this last point where we talked about in an earlier segment of today's show that there's 5 key ways that we bring inflation risk down. One of them is having a growth portfolio, a part of their portfolio that has equity or stock market exposure. That's going to be important for people, even though they might be risk averse. So there's 3 ways that we dial back or bring down the risk for our clients in retirement. One is quantitatively. Most people in retirement still are recommended by banks and brokers to have a 70-30 portfolio or a 60-40 portfolio. We think that that's crazy. Our clients have exposure of about 25 to 30%, not 60 or 70%. So that's point one. Quantitatively, we dial the risk way down. Second, we eliminate interest rate risk. So Mark Knauss, you're going to be jumping in and talking to us about interest rate risk and why that's important, especially with what the Fed is up talking about and lowering the Fed rates here, quarter point here any day. But we eliminate interest rate risk by not having our clients own any bond funds. Bond funds lose value as interest rates go up. So, for example, from 1940 to 1980, the 10-year Treasury went from 2% up to 15% during that 40-year period where interest rates were trending higher. They peaked. Paul Volcker took precautionary action, started bringing things down. From 1980 to 2020, 40 years, next interest rate cycle, interest rates went down to 0.47 on the 10-year Treasury. At 0.47, you're almost at zero. Any bank or retirement advisor telling clients to have bond funds, it was just crazy. So we saw that there's hardly any gain to own a bond fund because at 0.47, you're not even making 0.5%. But if interest rates go up from there, you're losing money. So that's like investing in the stock market where it can't go higher than 30,000 and it's at 29,500. Well, that's silly. You've got all the downside risk and very little upside. So we eliminate interest rate risk. And by the way, if you've owned bond funds in the last 5 years, they've lost over 35% on average. So we want our clients have not taken that hit because when interest rates are close to zero, it's only one way that they can go, and they did. And now the 10-year Treasury went from 0.47 to it's been as high as 5%. Right now, it's pretty close to 4. Now, the third way that we lower client risk, one is quantitatively, second is we eliminate interest rate risk. The third way that we lower client risk is strategically. Now, we mentioned this in the previous sector or segment, that there's been 4 times that the S&P 500 is traded above a market valuation of 30 times trailing earnings. Every time the markets get to this high valuation, future returns are flat for 10 to 15 years. Well, if that's the case, there's 2 strategies that can make money in a flat market cycle. One is dividends. So in a dividend portfolio, which we have, our clients are going to get paid that dividend whether markets are up or down. You just let the income roll right in. The second way is momentum. Momentum buys what is going up. There's always something going higher. In 2022, it was energy. In 2008, when the markets were cut in half, it was treasury bonds up over 20%. In 2000, 01, and 02, it was gold, silver, energy, pharmaceuticals, biotech, healthcare, all made good, strong returns when most people lost half their money. So what we've done is we've taken momentum and cut it in half so that when the market is trending higher, trading above its 200-day moving average, we have the offensive team on the field, ready to put points on the board, aggressively going after as much upside capture as possible. But when the markets start a downtrend, we pull the offensive team off the field and we put the defensive team on the field. Its job is twofold. One is to make money if possible in a down market. And second, at the very least, it's to minimize any losses. We are strategically lowering our client risk quite a bit. And quantitatively, we lower our client risk from 60 to 70% exposure to stocks to 25 to 30. And then finally, we've completely eliminated interest rate risk. So Mark, we covered a lot of info there, but talk to us about the difference between real returns and nominal returns.
That's a great question, Brian. And just to kind of touch on what you were just mentioning, in a falling interest rate environment, like we saw basically over the last 40 years from 1980 to 2020, capital was getting cheaper and cheaper and cheaper and cheaper. So the smart money was going and leaning into growth-focused strategies because these tech companies could borrow money at cheap rates and then they can go and do R&D, and then the future growth expected was very good. So you could borrow for a little and get very high returns in the growth sector. But here we are today with interest rates much higher than they were back in 2020. And we're starting to see strategies like dividend and momentum and even hedging strategies start to perform very well with less downside risk. And I think in the coming years, that's really going to be where the smart money moves, is how do we protect what we have from inflation and still get good growth in the long term? To that end, we have to think about inflation as a component of returns, stock portfolio and returns on investment after inflation. So, say for example, you have a portfolio that's invested primarily in money markets and CDs and bonds. So, you're in a very conservative portfolio, and in aggregate, you're getting maybe 4 or 5% rate of return on your portfolio. But wait, your financial advisor is charging you 1% on that portfolio. So take off 1% from that. So your real rate of return is, what did you make after inflation? So let's say you made 5% on your portfolio, but inflation was 3.5%. So your real rate of return for that year would be 1.5% rate of return, barely enough to keep up with inflation. And if you add taxes in on that, in an IRA, you've got income taxes. In a non-qualified account, you've got capital gains taxes that you have to pay. So at the end of the day, I mean, did you really make any money in your portfolio, or are you just keeping up? Are you just treading water? So that's not good enough when you're talking about a long-term investment strategy to just tread water. So you need to have an eye towards real rates of return versus nominal returns, because that gap between the two really matters. If you're making 4 or 5% and your real rate of return is 0 to 1%, then you're not doing well in the portfolio and in the market. And you need to lean more into higher growth strategies in order to keep up with taxes and inflation. So it's why we don't recommend bonds for our clients. If we see continued interest rates going up, long-term interest rates, not at the Federal Reserve level. The Federal Reserve kind of controls the short-term interest rates. That's credit cards and money markets and high revolving credit. But you're talking about mortgage interest rates, and you're talking about corporate bonds and stuff. If we start to see rising interest rates in the long term, that can be really devastating for a bond portfolio, and that can be really devastating for very conservative positions like cash and CDs. You just don't have the growth that's needed to keep up with inflation. And we really need to protect our clients from inflation risk in their portfolio.
So, Mark, let's talk about what happened a year ago, September of 2024. The Fed cut rates by 50 basis points. And what happened to the bond rate? The 10-year Treasury rate actually went higher. So the Fed has control over the open market banking rate, but they don't have control over the bond market. It's interesting that interest rates went higher when the Fed cut rates a year ago by 50 basis points. Why is that? Well, the answer is there's 37 trillion reasons why interest rates went higher when the Fed cut rates last time. People are seeing that to have a country where 140% of the GDP is now in debt, that's kind of the marginal line where people say, I need to be paid more return to take the risk of buying these treasury bonds. If we had 20% of the GDP in debt, then we would be, the interest rates would probably be much lower because the risk is much lower. When you've got over 140% of the country's GDP in debt and climbing, and it looks like there's no solution to higher and higher deficits, then people are demanding through these bond auctions a higher and higher return to move this kind of huge volume of treasuries. So, Mark, talk to us why a bond heavy or cash heavy portfolio, they're especially vulnerable to inflation risk.
So bonds have what's called an inverse relationship to interest rates. When interest rates go down, the value of your bond fund will go up because the already issued bonds become a lot more attractive. So there's more demand for bonds that were issued 3 years, 5 years, 10 years ago when interest rates go down. But when interest rates go up, now all of a sudden there's less demand for older bonds and there's more demand for newer bonds. So people will sell off old bond funds and there will be a rush to buy the new stuff that's coming on the market. So you see interest rates go up, and usually you'll find that bond funds will go down in value. And if you're in a bond heavy portfolio and we see rising interest rates or we see inflation, you're going to see the value of your bond holdings in your portfolio lose money. And we cannot let that happen for our clients.
So again, if you'd like to talk with the team at Decker Retirement Planning about any of this, anything that really pertains to where you are on that road to retirement, this is your opportunity. There is no cost whatsoever to chat with the team. They're here to help. They just don't know if they can help you until you reach out. Great opportunity for you. 833-707-3030. Again, no cost to you whatsoever. 833-707-3030. It's time to get started. Get some clarification. Get a clear picture of where you are on that road to retirement. 833-707-3030. Brian J. Decker and Mark Knauss back to wrap it all up today, right here on Safer Retirement Radio, right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Again, a reminder on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. There's about 12 things you can download, including Brian's book on retirement, the Decker Approach book. Any and all of that is just there for your information. You can just download any or all of it if you'd like to. That's the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Again, if you want to talk to the team, it's 833-707-3030. All right, Brian, where are you and Mark going for this final segment?
Well, let's talk about bond ladders, CD ladders, municipal bond ladders, things like that, Mark. When it comes to taking the guesswork out of interest rates, say you've got $400,000 or $500,000 you want to put in CDs or bonds. How do you take the guesswork out? Well, let's say that it's $500,000. What we do is we ladder your maturities. 100, you would buy in on a 1 year, 100,000 on a 2, 100,000 on a 3, 100,000 on a 4 year, and 100,000 on a 5. So 500,000 is invested. You've walked up the interest rate curve, the yield curve, so that at 5 years, you're capturing about 85% of the total yield out there on a 15 or 20-year CD, bond, treasury, whatever. So you're capturing most of the upside, keeping things a little closer on the maturity. And then when your 1-year CD comes due, you roll it forward to a 5-year. So after 5 years of having a 5-year ladder, all of your CDs are getting 5-year rates of return, and you don't have to guess what's happening in the interest rate side, because if interest rates are going up over the 5-year period, you're getting higher and higher returns walking up the interest rate curve. If interest rates are going down, thank goodness you have 3 and 4 and 5 years out there, but you'll probably reinvest at a higher rate on your 1 and 2 year, because even with lower interest rates, you're going out taking 1-year money and launching it out 5, and taking 2-year money and putting it out 5. So there's a yield curve pickup in rate of return by doing it that way. Mark, as we do that with CDs or corporate bonds or treasuries or municipal bonds, it takes the guesswork away from if interest rates are do we think interest rates are going to go higher or lower? Mark, what else would you add to the laddered strategy?
I always tell people, when you lean heavily into principal guarantee strategies, you're going to likely give up growth in the portfolio. So you can have guarantees and you can have growth, or you can have growth, but usually it's more of one and less of the other. So a laddered strategy allows you to take on a little bit more risk in the portfolio. When you're looking out 5, 7, 10 years, well, we know that over time, markets tend to expand over time, and you want a growth component in your portfolio. So I I tend to like the idea of having my short-term money be very safe, very conservative, very predictable. But as I go out in time, I'm willing to take on a little bit more risk and get a little bit higher growth in my portfolio. It allows me to take advantage of compound interest and that market performance in the long run. Because if I'm going to invest money for 10, 15, 20 years, I don't want that money to be conservative. I want that money to be exposed to growth for as long as I can. So having a bond ladder, a CD ladder makes sense in the short term, but I want to start folding in more growth type vehicles and strategies for my longer term money.
Once we have a plan, we try to test it and stress test it with 22 different ways that we try to poke holes in it to see if it's going to work or not. And the first thing, top of the list, in my opinion, Mark, the first 3 things are more important than everything else. So let's see if we have time to cover these. They're all important, I should say, but these first 3 are very, very important. How much income do you want at retirement? That's going to drive the plan. And if you want X and you have assets of Y, and Y does not give you, let's say that you've got assets of $1 million and you want 100,000 from your portfolio every year for 30 years. Well, I think that that's stretching it. So what we do is we run the numbers. We're a math-based firm, and we see how much money the plan can produce with conservative numbers. And we want to make sure that there's a comfort level using conservative numbers to see how much income the plan can produce. Because, Mark, if they're short, we can calculate with the client how long they need to work before they can settle in and have a worry-free retirement. Sometimes we're in meetings where they think that they can retire, but they want to be sure. We run the numbers and we find out if they only need $12,000 net per month, we run the numbers and find out if they can get that. So, Mark, what else would you add? This is the first thing, most important thing. It's all about the income. What else would you add?
That's right. I like to tell people you need to know how deep the water is before you jump, because once you stop working and you punch that final paycheck, you start taking money from your portfolio, you're not going to go back to work. So you need to make sure that your income in retirement is enough to cover your expenses. So the 2 ways you do that are, number one, build out a plan, simulate living to 100 years old, simulate portfolio income coming into you using conservative estimates. How much on a conservative basis can you expect to receive from your portfolio for the rest of your life? But, just going back to fundamental financial advising, having a budget, making sure you know what your numbers are on a monthly and annual basis so that it doesn't catch you off guard in retirement. If you walk blindly into retirement, you can get really hurt. So sit down with a financial advisor, have these discussions, spend the time putting numbers to paper, and really analyze whether or not retirement works in your case. And if it does, fantastic. Then you know that it works. But you have to put it down on paper first before you make the decision. So having a plan is key to knowing whether or not retirement is going to make sense for you.
Okay, so number one, we run the numbers to make sure that the plan can provide the income that you need and want during your golden years of retirement. Number two is inflation protection. Now, we've talked about inflation for 75% of today's radio show. So if you didn't hear that, go pull up the podcast and you can hear today's radio show and make some notes on that. The next thing is stock market crashes. Now, Mark, if you're retired and you've got 60-40 or 70-30 portfolio, you've got tremendous stock market risk exposure. Our clients dial back their risk exposure in three different ways. One is quantitatively. The second is strategically. Actually, the third one doesn't apply because it's talking about bond funds. Those have interest rate risk. But Mark, talk about in the next 2 minutes, because that's all we've got left, in the next 2 minutes, how our clients are protected from stock market crashes.
Well, yeah, the stock market crash is probably the biggest problem of any financial plan. And Monte Carlo simulations will simulate what happens if there's a stock market crash right as you retire. We know that on average, every 7 to 10 years, the stock market has about a 30% drop. And that drop can have significant impacts on your plan. It can send you and people that you know back to work when you are really looking forward to the golden years. But our process is designed to sail through those type of market conditions because a core foundational principle of ours here at Decker is to be drawing income from principal guaranteed accounts in your portfolio that have no downside risk. So even if the stock market crashes, your money is coming to you from things like CDs and money markets and strategies that cannot lose money in the market. And so you just sail through those type of situations and let your long-term money be exposed to the risk of Wall Street and what's happening geopolitically or on, in the banking sector or whatever is happening in the headlines. That's long-term money, but your short-term money needs to be much more protected and have that safe component to it.
So again, if you'd like to sit down and talk with the team at Decker Retirement Planning, you certainly can do so. You have questions, you have concerns, income, investment, taxes, healthcare, legacy planning, Social Security, Medicare. All those decisions are on your plate as a person that is retired and you want to live your retirement in the way that you want to. You need a plan. You need a strategy. Brian and Mark and the team at Decker Retirement are here to help. 833-707-3030 is the number. Again, no cost for this, no pressure, no obligation. There's no judgment either. A lot of people think, I don't have enough to sit down with a retirement planning team like Brian Decker's got. Well, you don't know until you reach out. It's an opportunity for you. 833-707-3030, 833-707-3030. Brian, Mark, always a pleasure. Enjoy the rest of the weekend. We'll do it again next week.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Uncle Sam might need a loan soon from you. We have over $36 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.